Hi everyone, it's Mortgage Matt Family Eddie from Envoy Mortgage. The Fed just cut interest rates to 0%. The question is, what does that mean for the mortgage rate? So there's a lot going on. And in this video here, I'm going to pack some things. I'm going to pack what the Federal Reserve rate affects. I'm going to pack how the mortgage interest rate is determined. And I'm also going to go through some charts about volatility of the market from dating back to 1972 to current, as well as the past 3 years of market volatility, and just the current market volatility we're seeing due to the coronavirus. Wash your hands, wash your face, take a shower, take a bath. Don't do anything crazy. I also have some information here from the Federal Reserve Bank of New York. I highlighted some key information out of that I included here on my bullet points of list of how I'm going to explain how mortgage rates are determined, and that is by mortgage-backed securities. Mortgage-backed securities are the magic word that determine mortgage rates, not the Federal Reserve. So I'm going to go through my bullet points here. I've extracted information. I hope you find great value in it, and that's about it. So let's do that. It's March 16th, Monday, 2020, history in the making, and what a time to be alive. So, without further ado, thank you for tuning in. Just make sure we got these in order. So, hi everyone, it's Mortgage Matt Family Eddie from Envoy Mortgage. Topic of discussion today on Monday, March 16th. The Federal Reserve yesterday on Sunday cut interest rates to 0%. My phone exploded from past clients, current clients, potential clients, text messages, emails, phone calls, social media messages, one after another. Matt, our mortgage rate at 0%. The answer is no. Matt, how does the Federal Reserve interest rate cut to 0% affect the mortgage rate? Now, what I'm going to unpack here in this video is what the federal rate affects and what determines the mortgage rate. Mortgage rates are determined by what's called mortgage-backed securities. I'm going to unfold that here and unpack that further down in the video. But essentially this, mortgage-backed securities affect the mortgage rate. The Federal Reserve does not determine the mortgage rate. So the Federal Reserve rate cut to 0% is directly affecting things such as home equity lines of credit, credit cards, car loans, CDs, checking, savings, stuff like that. The Fed Reserve rate affects those directly. It does not directly affect or determine the mortgage rate. Now, what we're going to talk about is the mortgage-backed securities. What is a mortgage-backed security? Let's get into it. So, without further ado, we're now going to get into some of this talk, going through the bullet points of this strategically trying to outline what the MBS is, mortgage-backed security, to give you some information and value on this. And I hope this brings you great value. So without trying to read it off, I'm going to put these in perspective and kind of go through. So Fed rates dropped to 0%. As you all know, it has a direct effect on home equity credit, car loans, credit cards, bank savings, checking, and CDs, stuff like that. It does not set the mortgage rates. Now, the federal fund rate is the interest rate banks charge each other to lend Federal Reserve on an overnight basis, and this has a direct effect on the home equity lines of credit, etc. Now, what's going on right now is the Federal Reserve just announced that they are going to be pushing in a total of $700 billion worth of funds into the treasuries as well as into the mortgage-backed securities. That's great news. Trying to forecast rates isn't exactly the best thing to do in this business, but what we can say is that by funding in $500 billion to the treasuries as well as $200 billion into mortgage-backed securities, what we should see is a stabilization of the interest rate market for mortgages, if not a betterment in the mortgage rates for mortgages. So that being said, that's the it's a $500 billion in treasuries, $200 billion in backed securities, and when I say $500 billion in treasuries, the treasury bond, so basically that's when the government needs money, they issue a treasury bonds, and they issue the bonds to investors that buy them, and the money goes back into the federal government. So mortgage-backed securities, what is it? So a mortgage-backed security is a type of bond that is representing an investment in a pool of real estate loans. Now, when a bank issues a mortgage, how does it become a mortgage-backed security? Now, this is fun. Let's use this example. So, Karen wants to buy a home for $500,000, right? So Karen goes to the bank and typically will try to get a loan for $500,000. And what happens is the bank lends them that money, and to further along, the bank lends them that $500,000, and what used to happen is the banks used to tie up all that money into their overall capital, and they used to hold it for 30-year notes, say, at an 8% rate. So Karen would pay that 8% interest streamline rate and a 30-year note to that bank. What the banks ran into an issue is that they needed to free up capital. They needed to free up resources. They needed to free up money. So what they did is they thought, wow, we can do this by selling it off. We can sell off to investors the streamline refinance, streamline interest, and we can free up capital and resources. So what they did now, like what happens is when you get a mortgage, it gets written, and that mortgage goes to, what happens, it gets sold, and it gets sold in packs of hundreds, even thousands, and they go to an investment bank. And now that investment bank pulls them together as far as quality goes, and they get bought off by investors. And each investor buys the pool of loans, and essentially the investors are what control the mortgage-backed security. So before, where do you want to go there? Where are we headed? Yeah, that's the scoop on that. The bundle of the mortgages is sold to the investment bank. It goes to the individual investors. And basically, the mortgage-backed security is a way for a bank to free up capital. Now, the MBS mortgage-backed security, they are the instrument that controls mortgages. It's not the Treasury. It's not the 10-year Treasury. It's not the 30-year Treasury, etc. It is these mortgage-backed securities, the investors. The more mortgage-backed securities that are being bought, the more interest rates that are being driven down. The less mortgage-backed securities that are being bought, the higher interest rates go up, right? So if investors are buying more and more and more, interest rates are going down. If the investors are buying less and less and less, which has just happened recently, interest rates are going up. So here in the past 2 weeks alone, we've seen rates go from the literally historic lows to back to where they were in, say, 2017. And this all happens in hours. It can happen in a matter of just pricing changing within hours. Pricing go up 1 hour, pricing go down 1 hour. So that's an overall scoop kind of on the mortgage-backed securities and what that is. Essentially, a mortgage-backed security is what controls the interest rate for a mortgage. And it basically has to do with investors that investors that buy them from investment bank, and they control it. So the more mortgage-backed securities are being bought and money put in, the better interest rates are. The less mortgage-backed securities are being bought in, the higher interest rates will go. So keep feeding that money into the mortgage-backed securities. We need it. As mortgage professionals here, we want to see interest rates super low for your opportunity to buy. Now, I want to go over some history speaking. 1972. Holy smokes. 1972 current 30-year, 1972 to current on a 30-year conventional mortgage. The highest rate I see on here is in the 18% mark in 1980. Incredible. So let's just talk about interest rates now. Right now, as of 3/16/2020, the current interest rate average for a 30-year fixed rate mortgage is at 4.12%. 3/16/2020 at 4.12%. That's up 46 basis points from just a week ago today. Now, 1 month ago, interest rates averaged on the 30-year fixed note at 3.64%. So that just goes to talk about the volatility of the market, and that's what I want to uncover here and show you firsthand. I actually want to use that. This is the 3-year, so a 3-year chart. Basically, this is going to show you the blue line here on the top is the 30-year note. The green line in the middle is the 15-year note. And then the orange line that's all over the place is the adjustable rate mortgage, call it an ARM at 5-to-1. So check out the volatility in the market on that, right? up and down, up and down. Let's look at 72 to current. This is incredible, right? Up and down. Look how much it fluctuates going up. Why I'm showing you this is a good question, because the topic of conversation right now is, Matt, what's the current interest rate? What's my interest rate? Here's the thing, is your interest rate can be one thing at open market, say 9:30 a.m. If the market updates 1, 2, 3, 5 times a day, which we've seen recently, your interest rate can go up or down, for the better or the worse, 1, 2, or multiple times a day. Now your interest rate is going to fluctuate until you go into contract a home and lock it. So answering that question right now about what is the interest rate is a tough conversation to have with people in terms of relaying the understanding that interest rates are fluctuating so much right now. The volatility in the market is like just, what's important right now is that you are prepared for when interest rates drop. How are you prepared? Your application's in. I know where you stand, I know where you need to be, and I know when interest rates drop, and when I see it, I contact you and we lock it. And we save you money on your refinance, or if we're under contracting your purchase, we lock it. That way you are locked in at a low rate. I just gotta tell you, I mean, I had some people last week on Monday and the Thursday, Friday before that were getting quoted anywhere from 2.65 to say 3.25 on 15 to 30-year mortgages that didn't lock some refinances. And now, as of today's pricing, I sent them the scope where they're currently at. You know, I sent them the scope on a bi-weekly or a weekly, daily basis. But my point is, they went from saying 2.75 rate to now that person's at a 3.5% rate. We saw an absolute increase in pricing for the worse. As of today, it's Monday, again, March 16, 2020, a day in history for the books. We won't ever forget this time frame for sure. And you know, pricing's got a lot better today. And I can say it's gotten a lot better today in terms of, I had an application income over the weekend, and that qualifying interest rate for that applicant was at 4.5% for what's called a conventional home-ready product. This morning, when the market opened at 10:30, which was delayed due to the volatility of the market, that person was now quoted at a par rate, 4% even, a full 0.5% fluctuation in a matter of just over 24 hours. Volatility of the market right now for interest rates is bananas. And it's just, you know, it's a topic of conversation. It's pretty heavy right now, but overall, without taking on this video for 35 minutes, it's great to do a long form video here on the YouTube. I'm going to start ramping these back up. I hope you enjoyed it. Probably post to Facebook too. And yeah, baby, rock and roll. It's at Mortgage Matt Media on all platforms. I hope you found some value in this video, going over what the mortgage-backed securities are, and just really honing in and emphasizing the fact that the Federal Reserve rate is not the mortgage rate. Mortgage rates are determined by mortgage-backed securities. If you have any comments or questions, please let me know. I'd be happy to send you an email or DM right back, and let's get to it. Thanks for tuning in, and I hope you have a great day. Wash your hands, wash your face, and stay clean.